Today I'm going to give you my gold price projection. I'll show you the metrics I use to gather the data to come up with an estimate which should be fairly accurate for you to assess the price of gold. Here I have the different years. Here, this next column I have the M2 money supply, which is all the money that's in the economy that can be easily converted to cash within about 24 hours. This next column, I went ahead and I simplified this column. I basically removed 9 zeros to get a better ratio. I didn't want anything in the thousands or hundreds. You can see the ratio varies from about 15 to 1, which I will explain. In this next column, column E, I have the gold price for the corresponding year. So we'll see that in times of ultimate despair, let's call it, or in times of neglect, I like neglect better. In times of neglect, where gold is undervalued, you'll see a higher ratio. For instance, we'll start at 1968 because Nixon closed the gold window in 1971. So that's when you can kind of see a better free floating gold price in terms of dollars. 1968, the ratio was 1. I came to this ratio by taking this M2 simplified and I divided it with the price of gold, which gave me a ratio of 13.5. This ratio, high ratio, signifies that gold is undervalued, and it signifies that gold is a buy. And if you buy gold during the period, you'll get stellar returns. You can look from 1968 when we had this high ratio to 1980. This is when gold was pretty much at value. The lower this ratio goes, it signifies that there's been a revaluation or a move to the price that gold should be. So typically this happens when stocks either stagnate or you see a precipitous decline in stocks. So derive this price dividing this 1512 by 850. This ratio typically gets to 2, which I'll show you, or around that from 2 to 5. And this is all the money that's in the economy. As of 1980, it was 1.5 trillion. Stocks, they moved up from 1980 to 1999. The Fed continued to print money. This money supply has actually been doubling every 2 years, which creates a very inflationary process or inflationary environment, let's say. So this M2 money supply went to 4 trillion. A lot of money focused on gold or stocks, and gold became neglected, got to this high ratio. You can see 15, 14 here, let's call it 15 here. This got a gold price of 270. 2008 money supply is about 7 trillion, almost double. Well, it would have doubled in 2009, but this is only 9 years. And the ratio it got lower. It got to a 8 ratio. Gold price went from 270 to 920. Let me just backtrack rather quickly. You can see 1968, the gold price went from $40 to $850. So getting back to 2008, 2011, money supply went to 9 trillion, 9,000 here. This ratio contracted, went to 5. Got a gold price of 1820. This was the high gold price, so you can see it went from 270 to 1820, $1,820. And stocks once again begin to get bidded up as the PE ratios on the stock market expanded. I think 2011, I could pull up the data, but that's not too important. Just know that the PE ratio went to maybe 15, 18 to 33 in 2018. As you can see in the current time, 2018, 2019, this ratio went to a 12. So it's pretty much in line with the previous high ratios when gold was devalued or when gold was neglected and other spending was higher. So you can see this ratio 12, money in the economy 14 trillion as of early 2019, about 14.5 trillion, and the gold price is 1200. I think February is about 1310. But so to project the gold price, what we can do is we can take this M2 money supply, because this is a known. The M2 money supply, we can kind of, we know what it is currently, and we can kind of project what it will be at the future rate of growth, or based on the previous rate of growth. As I mentioned, it's been doubling every 10 years. So that's a known. And this ratio is a known. We know that in times of neglect, this ratio will be high. And in times of a full market revaluation, this was a revaluation 1935, we know that this ratio gets to about 1 or 2. 2011, it wasn't a full revaluation, or it wasn't extreme despair in the market, as the PE ratios only hit 15 in 1980, 1935. You're looking at sub 10 PE ratios in the stock market. So let's take this out. And my true goal projection is 2025. I took this trillion, this 14 trillion, and I estimated, I think, about 1.2 trillion added a year, from the 14 to double to 28 by 2028. And I only did 7 years. So I got to an M2 money supply of 22 trillion. Simplified, it's 22,000. And I took this modest ratio of 5 that the gold hit in 2011, and I got to a 4,400 gold price, which a lot of people may not want to hear, because of course they want a higher price. And in a hypothetical extreme case, I took this 1.8 that we got to a ratio of 1980. We got to that ratio 1935, actually a little lower. And I arrived at a gold price of 12,222. So this is my, let's call it, what year are we in? This is my 6-year gold price projection. Also, a thing to note is that gold moves rather slowly. If you can see from the 1968 time to the 1999 to the 2011, you're looking at least a 6-year time period. More realistically, probably a 10, but you're looking at least a 6-year time period. So I believe that we're going to hit an extreme. So the gold price per ounce is at least going to be 12,222 based on the amount of money in the economy. And if this gets to a full double from the 14 trillion, we could just take the 14 trillion, double that, it'd be 28 trillion in the economy, which is a 28,000 number. And if we divide that 28,000 by 2, we're looking at $14,000 gold per ounce. This is what the price should be if that M2 money supply reaches that level. So let me know your thoughts. What number did you conclude for a gold price, or what do you think about my analysis? I think it's pretty simple but powerful. And I did it for silver, oil, a bunch of other commodities, which I'll show you in other videos. Thanks for watching. To subscribe for more financial content, please click the circular button where the red arrow is located, and also watch one of the top 2 videos up top.